Welcome to the Real Talk Retirement Show, where we explore the financial side of retirement and beyond. Whether you're currently retired or planning for the future, we offer real, relatable conversations about money and personal finances. Most importantly, we dive into all these topics using real talk. Now, let's get real about your money and your retirement.
Welcome, everyone, and thank you so much for tuning in to episode number 1 of our Real Talk Retirement Show. My name is Brian Graff, and I'm here with my co-host, Tracy Burke. Tracy, how you doing today? You ready to jump into this podcast thing with me?
Absolutely. Super excited to be with you, Brian.
Yeah, well, and as you might have guessed by the title of our show, this podcast is really about retirement. But if we're being honest, we don't know a lot about podcasting. This is, I think, a first go around for both Tracy and I. So please bear with us as we kind of get our footing here and work through the process. But we're super excited about the opportunity. But one thing we do know quite a bit about, I think it's safe to say, Tracy, is retirement. I've been in the industry for about 25 years now, talking about retirement to people every day. And to put that into perspective, 25 years, if a child was born the day I started talking about retirement, they would qualify for discounted rates on auto insurance. So I think maybe that ages me a little bit, but yeah, this has kind of been my passion for the last 2 decades and a half. Tracy, tell us a little bit about what you do here at Conrad Siegel.
Yeah, thanks, Brian. And again, I'm thrilled to be doing this with you and seeing how we can help everybody that's listening, both that are in retirement and also preparing for retirement. So I've been an advisor working with investors and families for I guess about 20 years now, and really look forward to sharing some of what I've seen over those years. Our wealth management team here at Conrad Siegel is really fantastic. We spend most of our time working with or I guess on behalf of our clients to help them be successful. And we try to have this down-to-earth approach and giving them the peace of mind as we help them navigate the financial world together. And Brian, I would say, I'm super excited about this podcast because I think, as those who view it just as another outlet to help people, and of course that's our goal. But really, we want to help simplify these financial topics. Want to help to provide clarity when it comes to everybody's retirement. So we want to help, these folks that are listening be confident. And sometimes, these topics can seem complicated, and we just want to unpack it in a simple to understand way. So I think with all that in mind, Brian, I would say let's just jump right into our first topic today. And this is a question that we get a lot, which is why we wanted to start with this topic. But the question really is, how do we know if we have enough money saved for retirement?
Right, it's that $1 million question, right, Tracy? I mean, as a retirement educator, and by the way, I work predominantly with employees in their workplace retirement plans. So everybody, some people I talk to have a zero balance in their retirement plan. Some people have $1 million or more. So it really does run the full gamut there. And that question comes up through by everybody. What is that magic number? What do I need to save? And it's a stress point for so many of us, right? So I think it's important that we address it. But Tracy, in your opinion, why is it so important for us to figure this out, this magic number?
Yeah, so of course everybody wants to have enough money to live through retirement, and that's the ultimate goal for both those in retirement that they don't want to run out of money at some point in the future, or for those pre-retiring and again trying to figure out what's that number I need to be able to walk away. And of course nobody wants to run out of money. Or
Right.
even, some people say, oh, I would love to bounce that last check that I write, way
Yeah.
down the pike. I think that's very unlikely to do. But, as I think back through, in the 20 years I've been doing this, I don't think I've ever heard somebody say, I wish I didn't save so much. So obviously we want to get people to be able to get to that spot, really to retire on their own terms. And whatever age that is, as people think through into the future of when they might want to retire, for those who are currently pre-retirement, trying to think, I want to get to this point where I can retire on my terms.
Yeah, Tracy is almost kind of like, waking up every day and saying, hey, I can kind of do whatever I want today, right? Within reason and certainly within the law. But I mean, really just having the independence and the freedom to do that.
Yeah, absolutely. And that's exactly what it is. So, Brian, as we think about what all kinds of information is out there and what key pieces of information we want to share with the listeners here today, there's tons of statistics out there, right? Everything in life, you see tons of statistics. And many ask that question, well, what should I have, or what's the normal? What sort of rules of thumb? So, Brian, what are some of those numbers that we use?
Yeah, and I'll start off by saying, and I say this in a lot of the education I do, is that magic number is different for everybody, right? So it's not a one size fits all. So much of it depends on, your income level that you're used to living at, what your retirement vision looks like. Do you want to travel the world, or do you just want to make sure your debt's paid off and go fishing on the weekends or play with the grandkids? Those are two extremes, right? Most of us fall somewhere in between. But as Tracy alluded to, there are some really popular benchmarks used in our industry to kind of help you along as you plan for retirement. And for example, our friends at T. Rowe Price recommend that you have about 7.5 to 13.5 times your final year's salary saved for retirement by the age of 65. To simplify that even a little bit more, Fidelity uses a number that says by age 67, which is considered full retirement age for most of us by Social Security these days, you should have about 10 times your final year's salary saved for retirement, again, for that comfortable retirement. So to put an actual number to that, let's say your final year's salary is $100,000. Using Fidelity's model, you should have about 10 times that, or $1 million saved for retirement. So just some benchmarks to think about. Everybody likes to have some goals or numbers to kind of ponder. Those are ones that we would recommend you consider.
Yeah, and Brian, as you said earlier, it's not a one size fits all approach, right? So certain factors that will make the difference. The amount that you're planning on spending, and we're going to talk about that in a little bit here. When you're going to retire, those metrics that you just gave were retirement age. Perhaps, and some people want to retire earlier, some people want to retire later. So that all affects, obviously, you need more if you're going to retire earlier and less maybe if you retire later. How aggressive you are investing, right? If you're looking for, if you're putting your money into bank CDs and getting maybe over the longer term 2 or 3%, your number's gonna have to be higher as well.
Sure. Yeah.
Versus if you're getting, rolling the dice and getting some maybe higher expected returns. And then the last thing that comes to mind is how long you're gonna live. And I don't know, Brian, if you figured that out yet. I don't think I have, but trying to figure out how long you're gonna live, and we've heard people say, well, geez, I have longevity in my family, or everybody in my family, my heritage, they pass away by a certain age, an earlier age, but nobody knows that answer.
Yeah, that's true, Tracy. And hopefully we all live a long, long, prosperous life and get to enjoy our retirement. But again, you just never know. But let's kind of get into the meat of today's podcast, Tracy, if you will. And what are some of the ways that you recommend individuals figure out if they do have enough money saved for retirement? Maybe that's just a little bit more in depth than those benchmarks we talked about earlier. What are you telling people out there, Tracy?
Yeah, for sure. And there's really three different pretty common methods here, and we'll try to go through them briefly as we do it. So I'm going to geek out a little bit here. The good news is we do have a resource, or really a worksheet, to help everybody through this. We're going to put that out in the show notes. So visit the show note page, and you'll be able to download that PDF and help you through it. But so the first one, mentioned there's three. The very first one, it's what we call the income replacement ratio method. And what that means is sort of what it sounds like. You're going to take your final income that you're making pre-retirement and taking a ratio of that to replace your income pre-retirement into retirement. So a broad example, Brian mentioned maybe $100,000 of an income before retirement. So what we do is we take that number, then we back out any expenses that will likely be eliminated that were there during our working careers. Now, some of this is some of those pesky payroll taxes, the FICA, sometimes, state and local taxes. And it depends on what state you live, locality you live, all those type of things. Work-related expenses, even savings that you're saving for retirement. We back those out because in retirement, you're no longer saving, right? So any of those outflows that have been happening during retirement, we back those out. Then we add some expenses that typically will show in retirement or come up. So maybe that's additional healthcare expenses. Maybe it's leisure expenses. Golfing. I know, Brian, you're a big golfer. So, a lot of folks go into and have these hobbies that take up a little bit more. So we back out some expenses. We add in some expenses that happen after retirement. And then we sort of get to whatever that number is. And generally, the rule of thumb I think we've seen is generally 80% plus or minus
Yeah,
is
Tracy, why don't we use that number? By the way, real
yeah.
quick side note too. Tracy said I'm a big golfer, but that does not mean I'm a good golfer. But anyway, just a quick aside there. But yeah, I hear that 80% number used a lot. Why is that so common? Because of some of those expenses that go away, and I know there's some that get added. And what's the general rule of 80%?
Yeah, absolutely. And a lot of folks we talk about this a lot with investors, right, Brian, that you should be saving 10 to 15% of your income for retirement. That's one of those numbers that's getting backed out. We think those expenses for those FICA taxes or other taxes, FICA, it's Social Security, Medicare taxes you pay while you're working. Right there, that's over 7.5% that's backed out. State tax, some of the other taxes that come in. So, typically you could see 25, maybe 30% of your pre-retirement
Yeah,
earnings
for
being
sure.
backed out before what you add.
Yeah,
Yeah.
no, thanks for that. That makes sense. And because it's a number we use a lot, we throw it out there, and I get that question sometimes. Like, well, why 80%? Like, why don't I need 100% of my income? I'm used to this lifestyle, but I think when you mention all those different figures and those takeaways or those subtractions, I think then it really starts to make sense to people. So yeah, thanks for that, expanding on that a little bit.
Yeah, for sure. So then that takes us to the second method I mentioned. Now, rather than ballparking it, which is the first method, it was really ballparking it, right? Now the second method is really, the detailed expense analysis component. So this is where you're just doing sort of a line by line item. You're figuring out what are my expenses going to be in retirement. In this worksheet that we're providing, it breaks it down into different areas, but housing is one. And that includes, utilities and everything, property taxes, insurances, all those type of things that go into housing. Obviously, that can be a big chunk. Whether it's transportation, other living expenses, certainly groceries, clothing, all kinds of stuff of that nature. Taxes, of course, that's part of what's going to be going out the door, and that's going to change in retirement, but still, unfortunately, still got to pay taxes, right? In terms of insurances we talked about, and then sort of that all-encompassing other category. So more discretionary expenses, just personal care, cell phone, and probably most people say that's not discretionary anymore. You need that cell phone,
True.
but
For
dining
sure.
out, entertainment, gifts, all those type of categories where again you're going sort of line by line and trying to figure it out. So Brian, as you can imagine, that way can get a little tricky because there's areas where you might forget about, right? That can be something where you might go through and you just might forget about even major categories. So that can be a little bit a little bit tricky to go that way.
Yeah.
So before we go on to the third method, really for either of those first two, the next step then is to figure out what you need to take from your portfolio. And again, we're sort of backing into that ultimate question, right? How much do I need for retirement? So, the next step is after you figuring out what you need for your retirement income number. Well, thankfully, almost everybody has Social Security coming through the door. And some folks might have other income sources. Maybe it's rental properties. Maybe they're doing some part-time work in retirement. Maybe they even have one of those old-fashioned pension plans, right? So, in that example we were talking about, Brian, if we, have 80% of replacement and say, $80,000 is the number we need. Maybe that person has $20,000 coming in the door through Social Security collectively,
Right.
whether it's, just single or married. And then, maybe there's another 10,000 coming from a pension. So we back out 20 plus 10 from the 80. Now we're down to 50,000. So in that first year of retirement, that person would really need to withdraw from their savings, $50,000. And again, backing out what's coming in the door. And then sort of the final step to get to your number, and sort of drum roll here, we're coming down to home stretch, in terms of that, finding what's a safe withdrawal rate. So if I need to take out $50,000 from my portfolio, what percentage can I take out that's going to be sustainable throughout time? And there's been many, many studies on this, and sort of that 4% range. It can be 3 to 5%, probably a safe withdrawal range. But the most common one we've seen out there is 4%. So if I take $50,000 that I need to take out of my portfolio, divide it by 4%, if you're using calculator, divide by 0.04, and you get to the number. And the math in that example comes out to $1.25 million. So if you need to take out $50,000 of your portfolio and you feel that 4% is that safe withdrawal rate, you need $1.25 million to take out. Does that make sense, Brian?
Yeah, it does. I like the math element of it, and it's something like Tracy said. Look at the show notes for some help with that, maybe for some guidelines. But for those of you that enjoy kind of nerding out like Tracy does on the math part, it's really not that hard of a calculation, I promise. But that does make sense. And I think one of the key things though too is, and you're right, that 4% rule comes up all the time in my conversations. It's something that's tried and true. It's been around for a long time, but also it's not 100%, is it, Tracy? And I think it's really important to have that flexibility in retirement, right? Knowing that these equations are not necessarily a one size fits all. So would you agree that that's true too? 4% isn't necessarily for everyone in every situation?
Yeah, absolutely. And again, it depends on how you're investing. If you're super conservative,
Yeah.
4% might be pushing the envelope. If you're only getting 3% off of CDs or something like that, that might be inhibiting in the future. Or on the other end, if you're much more aggressive. So that leads nicely, Brian, into really the third and final way that we like to see people use to figure out what their number is. This one I think is in my mind the easiest method, and one that we use with many of our clients as well. And it's just really called a 5% guardrails approach. So, it's a guardrail. And if you think about, you're driving down the highway, of retirement, you're driving down through there. Nobody wants to run off the cliff or off the edges, right? You want to stay on the road. So imagine you have guardrails, both sort of on maybe the top and the bottom. So you're taking your retirement income. And what sometimes, Brian, we've seen with a 4% number for folks that are moderate type of investors, and maybe that's anywhere between 40 and 60% of stock exposure in their portfolio, the
Right.
allocation, sort of moderate investors. What we've seen, the 4% number, their money continues to grow and grow. And sometimes they might retire with $1 million. And when they pass away many years down the pike, they might have $2 or $3 million. And I think for a lot of people, that's not the goal, to have more money when you die than when you retire, right? The opposite, of course, isn't the goal either, where you start in retirement with whatever you have and you go down to zero, right? That's not the goal. So really, this guardrails is that nice middle of the road approach. It sort of keeps you in that range. Your portfolio's not driving up, it's not driving down, it's sort of keeping you in there. And really what it does, if you hit the top barrier, guess what? You can spend more. If you hit the bottom barrier, you might have to cut back some from the withdrawals. So that mindset, it's really about a 5% number, give or take, and it depends on how aggressive you are. That's how we work with our clients, and just trying to figure what that number is. Obviously, there's other ways to do it, but that's a pretty good way that we like to see it. And again, just like the first two approaches, back out where you're going to get from Social Security and other income as you get there. But again, that's my favorite approach, the guardrails. I think it's probably pretty simple of figuring out how much you really need and how much you can spend in retirement.
Yeah, Tracy, a couple times I know you mentioned sometimes you can be invested a little too conservatively, which you may
Yes.
have a little bit of hard time staying in line with your retirement objectives. Sometimes you're a little too aggressive, which maybe kind of hurts your portfolio a little bit in those early years. I'm curious. I know future episodes of this podcast, we're going to take a little deeper dive to investing specifically, but a number that we hear a lot, or a mix we hear a lot, is like that 60-40 portfolio.
Yeah.
And I'm just curious to see, like, if you're for a normal retiree, that maybe they're right in line with their retirement goals. They've done the planning, they feel like they've got just enough in their portfolio. Is 60-40 still is that an appropriate number, or does it really just depend on the situation and the goals of the investor?
Yeah, I think it certainly depends, and mostly on risk tolerance, right? 60-40 portfolios in retirement can take a nosedive and will. It's not, it's not if it's going to happen, it's when it's going to happen. We have to
Right,
prepare
right.
for that and just have to be able to tolerate and ride it through. But the other factor is the 40 is, I think, in retirement, the most important number. And even some people are 70-30 or 80-20. You want to have enough in that fixed income bucket because when equities go down, most of the time fixed income goes up, and most of the time I emphasize that a little bit because in 2022, and probably many of our listeners have are thinking, well, yeah, everything was down 2022, and it was.
Yeah.
Generally, that's not the case, but when stocks go down, bonds normally hold their own, and you don't want to be forced to sell from stocks when you're taking money out of your portfolio, right? Successful investors sell high and buy low, so you don't want to sell when the stocks are down. So again, with that mentality, you have money in that 30-40% bond exposure, 50%, whatever your comfort level is. Make sure you have enough in bonds so you can take money out, maybe for a couple years in a row, to allow the stocks to recover after that decline.
Okay, yeah, thanks, Tracy. Again, because that one comes up so often in my conversations. People hear that 60-40 all the time. So I appreciate your insight on that. All right. So, our goal here at Conrad Siegel through this podcast and pretty much everything we do is really to simplify the complex, right? We don't want this to be difficult for you. I know we threw out a lot of numbers at you, hopefully in pretty easy to understand terms, but maybe if we kind of finish things out today, Tracy, I think we need to get some action items, right? Because I don't think these podcasts are going to help too many people if we don't give them some clear, concise things that they can do now or in the near future to maybe be prepared for retirement. So do we want to go over some action items?
Yeah, absolutely. And let's start with pre-retirees. So again, we
Yep.
said that, everything we're going to talk about in all these shows apply to both people in retirement as well as people preparing for it. So let me start with the folks that are looking to retirement. And obviously the number one action items, and these are pretty big item, big picture items, but figure out what's your number and or have that plan, that retirement plan in place so when you can retire. And as we mentioned a couple times now, the resources out there in the show notes. So take advantage of that. Reach out to us to help, and we're happy to help you walk through that. And then I would say the second action item is really start dreaming or thinking about what retirement's going to look like for you. If that's in a horizon, whether it's within a couple years or 5 or 10 years, or maybe even longer term, start to formulate that. What do you want your retirement to look like? Because that can help you plan for it. If I want to take a vacation to Hawaii every 3 months in retirement, I need to plan for that. I'm going to need to save a heck of a lot more than I'm saving right now, right? So
For
those are a
sure.
couple of action items I'm thinking of for people leading into retirement or pre-retires. But Brian, what are you thinking of for those already in retirement?
Yeah, for sure. And I guess, Tracy, one of the other expressions we use a lot here is retired to something, right? Not
Yeah.
from something. So I like to throw that in as well too.
Yeah.
I think we all have those relatives or people we know that work so hard their whole lives, and one day they're retired and they're like, oh my gosh, now what am I going to do? And a lot of times they go back to work or they're miserable or whatever. So make sure, yeah, you like Tracy said, you do have that retirement vision picked out. But for those folks that are already in retirement, I think one of the most important things you can do is simply confirm that you won't run out of money, right? Use some of those like the 5% guardrails that Tracy was just talking about. And just revisit. Are you living your ideal retirement? Do you need to make some changes, both personally and financially, to make sure you are doing everything you dreamed about doing and just kind of living a happy rest of your life, right? That should be the goal of all this, again, financial and otherwise. So I think those are some key takeaways for both. Tracy, any closing thoughts before we wrap things up for today about everything we discussed?
Yeah, and again, everybody's situation is different. We're here to help. We encourage our viewers to reach out to us. Podcast@conradsiegel.com is the email address to shoot us a note. Let us know what you think, any future topics that you might have. questions, comments, anything we can do to help, that's what we're here to do.
Yeah, for sure. And again, this has been a fun time. Again, episode number 1. So bear with us. I think we're going to get a lot better at this as we go by too. And I'm pretty sure we don't have any sponsors. Like we can't be canceled, can we, Tracy? Is that a thing if we're just kind of doing this on our own? Or
I hope not. Yes.
well, we hope that everybody did enjoy it. And if you did, please tell a friend, a family member to tune in. The more people we have listening, the more people will be able to help. And that's what we love to do at Conrad Siegel. We are fiduciaries and we love helping people. So yeah, thanks everyone for taking time. Tracy, thanks for doing most of the heavy lifting today. I promise I'll do my share in future podcasts, but had a great time. Everybody, good luck and tune in next time for episode 2 of Real Talk Retirement.
Thank you for tuning into today's show. The Real Talk Retirement Show is created and produced by Conrad Siegel, an advisory firm that specializes in helping people prepare for retirement and beyond. If you want to learn more about our work or meet the team, you can visit conradsiegel.com. Information on this show is for educational purposes only and should not be considered personalized investment, tax, or legal advice. Before making decisions, you should consult with the appropriate professionals for advice that is specific to your situation.